That action will continue through this week as well. Let me bring on board Samir Dalal as well, CEO Natvarlal and Sons Stockbrokers, joining us. Samir, on the IPO front, let me start with that. Take a cue from what Meryl was speaking about. Anything that you are finding interesting and subscribing to, and what's your take on just the kind of moves we've seen on stocks which are getting newly listed?
Yeah, so good morning, Harsh, and good morning to the team and your viewers. So IPOs right now are very, very hot. Everyone wants to be part of it. These are not coming in at anywhere cheap valuations. They're coming in at premium valuations. And then after listing, they're going up even higher, right? It's a scary kind of a situation. Feels like a bubble kind of happening in the IPO market right now. Some of these issues, which are OFSs, more sale of promoting shareholders and no money going into the company also sends in a bit of a problematic thing. It tells you that there are people wanting to sell and take money off the table. I'm sure there is growth. I mean, I'm not tracking a lot of these IPOs, to be very frank with you, Harsha. This is not a space that exciting because there are 4,000 companies in the listed space. We can barely cover maybe 200, 250, 300 companies in the already listed space. It becomes very difficult to continually track these new issues coming in. When something hits our radar, when it hits our parameters of when it becomes an investment kind of a thesis, we'll obviously start looking at them. But at the moment, not focusing too much on that. So difficult for me to comment, but very overheated space is what I feel.
Samir, what we're seeing is that a lot of QIBs or foreign investors are now looking at this IPO from a growth point of view. You're not seeing the flows coming into the secondary market, but in the primary market where the growth is 25 to 30% on an annual basis or CAGR basis, you're seeing attraction there. Is that the trend that you also see when you speak to your clients?
No, that's not the trend that we are seeing when we speak to our clients, right? So there is obviously some people who are interested. There are IPO chasers in the market. They feel that, once you get the subscription, these listings happen at higher prices because in general, when an IPO should get oversubscribed, say 50 times or 80 times the way they are getting right now, it should tell you that there is no reason for the stock to come below the IPO price. So, there's money to be made, so why not make this investment? But does that mean that these valuations are justified? Now, many times we've seen in the history, let's go back maybe over the last 10 years and pick up the number of IPOs where just before the IPO, the year and a half before the IPO, the growth rates were great at 25, 30%. And then post that, 2 quarters down, suddenly the growth rate starts coming off. It comes down to 15%, and then people wonder. Many of these promoters are unknown to the market. We don't have any track history of how they're going to fare, how investor friendly they're going to be. So for me, I think I would much rather, and what I tell my clients is there are so many stocks that you can invest where valuations are damn attractive, far more attractive than what these IPOs are being given at. Why do you want to chase these IPOs? Why not invest in these where we know the history of these people, how they've behaved in bad times, good times? They have listing. They've been listed for maybe 5 years, 10 years, 15 years. And we can make returns there. You don't have to make immediate returns. IPO is what the attraction of an IPO is that, oh, I invest today, I put it through USBA, so I'm not really even putting in money. It's just sitting in my bank account. And if I get allotment, great, I'll sell it at a higher price. So, that kind of thinking without really studying a company and understanding the businesses is not that great. Mutual fund houses are okay to do it as an anchor investor for them because they do have very, very large teams who can study them and they are getting large commitments. When you're just going to hope for a commitment, there's no point chasing after that when you are getting stocks available in dime and dozen and plenty, as many as you want for your portfolios. So like I said, I'm not one chasing after.
Samir, if you look at the mobile PLI 2.0 which has come in, 62,500 crores which have come in, but the government has diluted the incentive from earlier what used to be 4 to 6%, now 2.25 to 5%. It's a tapering down and a path going forward for maybe all other PLIs who will be coming in, right?
Yeah, it has to be like that, right? You can't keep giving incentives endlessly. at some point of time, look, the industry has to stand on its own 2 feet, right? So again, the IT industry, when it first came in, they didn't have taxes, it grew, and now you're taxing them at the full rate. So this is standard procedure. There's nothing new that's come of it. In fact, it's good that the government has continued this 2.0 PLI because at the end of the day, we still want to be doing more mobile manufacturing. But what is there? What is a very interesting catch in this PLI that they've given is that you got to get more parts also from locally manufactured rather than imports, not just assembly now, but also that the parts that come in, certain percentages have to be locally manufactured. So if that incentivizes companies to buy those parts, to get new factories put up, it creates jobs. So it's the move in the right direction, if you ask me. I don't see anything wrong with that. At some point, these PLI schemes have to go. They have to come for industries where we are non-existent and where we already have presence. Those industries have to start competing in the international market and stand on their own feet. So that's absolutely fine. We are happy the fact that the government continues its PLI because at the end of the day, there has to be some benefits to push an industry to start becoming larger in size, growing the downstream, the upstream, all of that. So it continues, but you have to assume that at some point you're not going to keep getting this. So you got to work your business models around that rather than just waiting for government handouts to be profitable.
All right. I'll take a pause, Samir, give you a bit of a breather.
So I always look at gold as something that is a store of value. It is not something that I have ever looked at as an investment for appreciation, but the returns for the last 2 years have been absolutely spectacular, both in gold and silver, right? No taking away from that. Now, the point is that because of the war in the Middle East, because oil prices are up, because of the Ukraine Russia war, the worry of maybe China doing something in Taiwan, uh, there is uncertainty, and which is why people are moving to gold because they worry that what if equities decline, then gold becomes a store of value, and which is where the interest in gold comes. History has shown us that whenever gold moves up, equity markets become something of a risk, or even the economy is at a bit of a risk. So, if we are saying that gold prices should go up further from these already elevated levels, it sends a slightly scary picture out there. That's the first part. Now, the second part, which you asked about, should gold financiers be a part of the core portfolio? Look, they are good businesses, right? They're lending business, and the best part of our is secured short-term loans, usually ranging between 3 months to maximum a year, because they are secured. And if the payments don't come in time, these people can offload the gold and recover their money. And that is something which has excited the market. And if you see what's happened, so when I started tracking Manappuram and Muthoot maybe 10 years ago, that time they were charging 24% to their customers, right? And these were 3 month loans, 6 month loans, and 24%. Why? Because they were taking share from the unorganized sector, that is your money lenders. Now, what's happened is that a lot of that share, whoever was fundable by these gold, have come into the system. I'm sure there is more availability of it given the kind of gold hoarding that is there in this country. Um, but because the number of players have increased, it's like you today. We had the other day we heard Aditya Birla Capital is going to set up 1,000 branches. We know Samman Capital is getting into it. You know how aggressive some of these banks like CSB and all have been taking gold loans. So when the yields have now come down to 19% and below. And because they're secured loans, what stops it from coming down to 17%, 16% over the next couple of years? I'm not saying it's going to happen in a rush, but as competition intensifies, that will happen. So if spreads start coming down, you may be able to grow your book, and you're growing your book not because new customers are coming about. You're growing your book again because gold prices are going up. So you're kind of lending more money to the same borrower on this when he renews his loan after he repays his original one, and that is the loan book growth. So if you see, the volume growth has been in low single digits, but the value growth has been much higher. So that is always a risk. And I'm not saying gold will fall, but if gold prices come off, what happens then? So am I going to be buying Manappuram or Muthoot at these levels? No, I'm not, because they're already trading at 2 times book value. Muthoot is even higher. I think it's closer to 3.5 times book value. So are they making investment cases for me right now? No, they are not. There are other companies who are doing maybe housing finance trading at under one time book. I'll tell you, LIC Housing Finance is trading under one time book, secured loans. Why are they down? Because growth has been a bit of a concern. They've been growing their loan book at maybe 4%. And, they've underperformed their target at 10, 12%. But that's also secured, already a competitive space. And once the economy and the industry start investing more and banks move more towards industries and reduce their exposure to the housing finance, I think companies like LIC will find it easier to grow, and then suddenly a re-rating will come in and trading at 0.810. So those make better investment opportunities at this point than chasing after what's already run up and is trading at higher valuations.
Samir, now how do you look at in that sense the loan growth that we are seeing in the banking space, especially with respect to private sector banks? While the bigger boys like SBI is showing 18%, but they also expect tapering of that growth coming into the second half. But the biggest problem is the deposit growth, which is not coming in.
So deposit growth is one thing that is going to be problematic going forward. You see, people have gotten smarter. People want better returns on their money, right? So let's put it this. Back in the day, people who didn't understand debt mutual funds or bonds or didn't have arbitrage fund opportunities where they got, the tax advantage by getting a very similar kind of yield. So the big ticket, big FDs, they're all starting to slowly move out. Now you have these MLDs. There's a particular company giving an MLD where you are guaranteed a 6% over 3.5 years, minimum return compounded, that is, and it's part of the equity participation. So money kind of gets diverted towards that because you're getting an ETF with a downside protection. So when people are getting smarter and not putting money into banks, especially CASA, where you're getting 2.5%, 3%, that's going to be a trend that's here to stay. So banks are going to have to come up with alternatives, ways of raising money. I'm sure CASA will grow, but it'll grow at a much more muted pace than earlier. Coming to loan growth is something we believe will rebound very strongly and very sharply over the next maybe 2 years. So right now, a lot of the loan growth has been coming more from the retail segments, and the how do you put it? Companies, corporates have not been borrowing as aggressively for the simple reason that they've been having easy access to the capital markets, and the yields that they're getting, if I invert the PE ratio, is what the yield you get, right? The yield of that money is far lower than the borrowing cost from banks. So why would I go if I'm getting it if I'm getting a PE of 40 at listing, or if I'm doing some sort of private fundraising at 40 times earnings, 50 times earnings, it's 2.5% earnings yield, right? When I look at it on the reverse angle, banks lend money at 8, 9, 10%. So I'm getting the equity component much cheaper. But we feel at some point this trend will reverse. We need to see interest rates moving down. And I'm saying this, once the corporate sector starts investing a lot more, which we think will happen in the next 6 months, you will see loan growth picking up. It's just the fact that now the borrowing cost might be a little higher because you're not getting your CASA. So NIMs may not expand to that extent that everyone is expecting, but we still believe the loan growth is here to stay and these banks will continue to do well. It's just that they have to find this alternative source of funding, which they are looking at international markets and things like that.
Right. Okay, Samir, stay on with us. Lots more to talk about, but I'm going to take a very quick break and be right back.
Kind of like, if you look at the stock, it's come off quite a bit. Water purifiers, the leader in the space, the total penetration in India is only 7% in water purifiers. They have robotic vacuum cleaners and vacuum cleaning. They have air purifiers. So we think, the penetration in India is under 2% for both of those categories. Growth is got a long way to go. So if you have a 10-year kind of view, something like that could also be a very interesting play as they capture market share in all three spaces, and the overall market growth. Just to put it into a number, like water purifiers, which is the largest business, 7% is the overall India penetration. Korea is over 70%, Japan 80 to 85%. So the opportunity in India for that segment is so large. that we think this is something that will be a 10-year great multiplier story. So those are kind of things we are looking at and we are continuously investing in.
Interesting. A lot of other stocks which are going to be in focus. Of course, the EMS plays. The government has now notified a solid 62,500 crore rupees. Mobile manufacturing PLI for 5 years. So Dixon, Kane, Sirma, all of them in focus. Jubilant Pharmova as well. The US arm has got the US FDA nod to manufacture first batch of product on line 3. So look out for what that stock as well does. NTPC Green, they've won a 500 megawatt capacity as well. So look out for that stock. SmartWorks, which has added about 235 crore rupees of incremental contracted rental revenue. There is Amagi Media as well. Remember, there was a block deal on Friday where an SBI mutual fund has been a buyer in that 2.4% of a block deal. And then, of course, there are others like Tega as well, which is going to be making a preferential issue as well today. So look out for what that stock as well does. Oro Pharma is the other one in focus. The US FDA has issued one observation for their peptides unit in Telangana. So that's going to be one stock in focus. And then Lenskart 2, wherein SoftBank Vision Fund is likely to sell about almost 2.6% of a stake and offload that. Natco 2, wherein the US FDA has issued Form 483 with 4 observations for their Andhra Pradesh unit. That's the other segment which is going to be in focus. But Sameer, if at all some weakness plays out on the likes of an Oro, Natco, etc., purely because of the news flow around the US FDA observations, would that become a buying opportunity?
So I haven't seen Oro Pharma's the alert that has come. I need to see that. But yeah, I think these are stocks that will continue to do well. Look, the opportunity in the pharma industries for international markets, especially the US, is still very, very large. I would, even though Oro Pharma is good, I would say focus a little bit more on companies that are doing biosimilars, biological research. You have Biocon, obviously, which is one of them, and Dr. Reddy's, who is doing quite a bit of work in that space. The reason I say that is that kind of medication, the way the medication and the way the government and the way the FDI will take interest in increasing that kind of biosimilars opportunities is something that will scale up. It's still not extremely competitive. So when you get approvals for things like for medicines of those kinds, you will get huge market share gains and huge turnover and profitability gains. So that would be my first focus. But yes, something like an Oro Pharma on corrections is good. But again, valuations are not the cheapest there. Dr. Reddy's is still cheaper there. And the other option in the pharma space, something that we've always liked in saying that Sun Pharma is a very interesting play from the simple reason that they are not doing the just CDMO or not. They're doing branded generics, which is a huge opportunity and market because they are differentiating themselves and still getting a share of that market, which is going to be growing. So apart from that, they made this acquisition, yes, which is why the stock had been a little bit under pressure. But this is a cash flow accretive kind of acquisition. So you're going to start making money from day one once the acquisition is complete. So that will take away a little bit of the risk and the downside. But that is another counter. Once they keep getting new drugs and medicines launched there, you will see that top line and profitability growing quite a bit. So that remains another topic. But Biocon, Dr. Reddy's, Sun Pharma are the 3 tops, followed by, you can look at something like a Torrent in the mid cap. Oro is also there, but I find the valuations a little bit on the higher side.
Okay. Last off, curious to know, Sameer, how you're looking at the entire paint space, because Asian Paints promoters have been, consistently buying stock. You find that interesting because you rarely see a promoter buying stock in their own company from the open market unless, there are some triggers that they see.
No, so many promoters do buy shares from the open market. It's funny that you're getting to buy them at this point when everyone else in the market and the whole world is coming to sell their promoter shares, right? But then also you got to look at the fact that the paint industry, Asian Paints or Indigo or the likes have not done too much in the market. So the valuations have corrected. So maybe they are looking at from a longer term perspective as an attractive opportunity. For me, I still think this space, last time I think we had a conversation on this as well. Because of the competition increase that has happened with 2 large players taking a big share, I mean, not big share, but competitive, sizable share in the industry and wanting more of it, tells me that pricing power is not going to be in the hands of the paint companies. It's going to be more, kind of price cuts, margin pressure increase. They've shown that it's not the case in this time being, for the simple reason that even when crude derivatives and all of these went up, they passed on some of the price increases. But at some point, I think that's going to give, and Birla Opus, to get more market share, is going to become a little more aggressive. And when that happens, I think this is going to go through another period of lull. So nobody thought something like an HUL would correct in valuations from 4 or 5 years ago. I think it was 2,400. It's still at 2,200. I think you're going to see a similar side kind of a situation in Asian Paints and all of the other paint companies, where the stocks are going to be more sideways rather than up. And it's not necessary that the promoters know something about something. They may just be buying because they think this is the cheapest they've seen valuations compared to the history of the stock, right? So it might make some sense to add, but just because they are buying, would I go out and say it's a buy? No, it's not.
Right. Okay, makes sense. I mean, great to be having you on the show. Thanks for your time as always.
Thank you.